Hey everyone, thought we'd spend some time today and look at chapter 18 and chapter 19 in our text that we are reading. Chapter 18 is about the fast close, and chapter 19 is about SEC reporting, very high level review. And then there's a couple of articles that we'll look at, supplemental articles. One of them is on closing the books, and the other one is on Herbie, theory of constraints, and they use a coffee shop as an example, which should get your mind thinking outside the box on how to increase throughput and minimize process variation. So let's look at chapter 18, and actually I have Alex's PDF of the text I'm going to pull up here. All right, that might help a little bit as we go through here. I got a few notes in my text as well that I'll refer to. The fast close. We hear that term and we think, what are they talking about? It's closing the books. I'm sure you're all familiar with from back in your undergrad days. Closing the books. And I've mentioned this several times through the semester about how companies have continually moved up the deadline for getting the books closed, getting financials out there, having your conference calls, especially on a quarterly basis with your shareholders and analysts and so forth. Early in my career when I was at Nuclear Fuel, not a large company, probably at that time, $75 million a year in sales, which was early 80s was quite a bit. We didn't have as much pressure to close. In fact, I don't remember there being a deadline other than we try to get it done as soon as possible. 1994, when I went to ETSU, it was a big deal. And we had 3 days at each plant location. We had 3 days to, quote, close the books. And then, of course, then the corporate office would pick up from there and do the rest of the closing process that a corporate office would do before they issued financials. Of course, at the time, Exide was a Fortune 500 company that was publicly traded, and you were under deadlines in order to get your books closed for that reason. At Nuclear Fuel, we were a wholly owned subsidiary of, when I started, it was Getty Oil out of Oklahoma. Then it became Texaco. And there wasn't pressure there. I don't know, it's because of what we were doing was such a immaterial amount from the global standpoint of a Texaco or Getty, that it wasn't that big of an issue as far as the closing process. But again, that's early 80s. It wasn't as big a deal as it is in the 90s, and even more so now about getting financials out there for your creditors and your stockholders. But at Exide, it was a big deal. It was 3 days. And over that 19 years that I was the controller there, it gradually got improved. I say gradually, it got improved from 3 days to we had 2 days to get the books closed, 2 working days. So if the end of the month was on a Friday and it was the 31st or the 30th, you would have until the following Tuesday. Weekends didn't count, it was work days. So you had 2 days to get all the accruals in, whether it's revenue or your expenses, which is always 95% of what you're doing. You had 2 days to get that in and make sure everything was square. When I went to Lear, and I was only there a few months in 2013 after leaving Exide after 19 years at Lear, it was 1 day that each plant had to get the books closed. So that day started early, usually 7 a.m., and you probably didn't get done till 10 o'clock that night. That was a long day. Was that 15 hours? But that was what they were under as far as getting the financials complete at the plant. And then the corporate office would take over from there and trying to get everything put into financial statements and ready for the auditors to review. And of course, announce your findings or announce your results to, as far as earnings per share, to your creditors and also to the stockholders. So the fast close, they're using that term through here and in several ways, and we'll talk about that as we go through here. So as we go through and look at some of these comments here, and we are on page 323, and it does correspond with my textbook, which I'm glad. Different types of fast close, and it says there it's the fast close is simply an acceleration, right? Simply an acceleration of the standard closing process results in approximately the same financial reporting package being issued, possibly somewhat stripped down. All right, they use a term also there called the soft close, right there. Less labor intensive than a regular close because it doesn't generate as much information. All right, it's a soft close and a virtual close. They use a term like that. We never really called it that. We would call it a soft close. I mean, I did a soft close every week at ETSU. I don't know that anybody else called it that, but it really was a soft close in that, you know, as much as I've talked about the operating budget, of course, the CapEx budget, once that operating budget was in place, very first week, you had to do a forecast of where you thought that month was going to end relative to the budget. And that was really, how did you do that? Well, you did it based on a soft close of what expenses that you've incurred, how's your labor running, how's your variances running as far as to your labor routings and your standards that have been set. What kind of inventory losses do you have? Of course, depreciation is pretty much fixed, right? That shouldn't change. But things change during the month, and you have to, especially like if scrap is going up, if your maintenance repair, if you got a lot of expenses that are flowing through, you have to do a forecast, and that forecast is based on what's called a soft close. Now, virtual close, I guess you can kind of say those two are somewhat related because it says these involves the use of largely automated accounting systems that can produce required information at any time. You know what really made the process a lot quicker than like back in nuclear fuel when we had to do the closing versus what we were doing at Exide, and then of course at Lear. And of course Exide to me they were far ahead of Lear as far as at the plant locations in their automated systems and control of inventory. Even Exide really struggled to survive. That's a whole nother story for another day. But these automated systems, these ERP, as we talked about in 2020 and 3020 and undergrad, these ERP systems, in fact, is the final chapter of this text, of this book. These ERP systems allow for automated accruals for what's being received on your docks. And once you receive those goods, once you take ownership and the title passes to you, that really the accrual is made by the people working on the docks, the dock workers. Now they have no idea that's what they're doing, but when they're going through that purchase order in their online, whether it's SAP or JD Edwards or Oracle or whatever it might be, as they're entering those receipts on the docks up there, that goes automatically to your books as a debit to either inventory or expense, however the purchase order was set up with the general ledger coding, right? And of course, the credit would then go to really a clearing account. And it's a clearing account as a liability. And that clearing account would sit there, and that's an accrual, right? That's an accrual that goes to your books. And then once the invoice comes in, that clearing account, again, based on the purchase order, it knows the vendor, it would clear out that clearing account with a debit, and the credit would go to your vendor accounts payable, whoever that might be. Very simple. And that's what really improved the process of being able to close your books earlier is these automated systems. It helps to do the soft close, the virtual close, as well as your month end. That's why you can go from 3 days back to 2. And of course at Lear, it was 1 day, although it's really 2 days in one by doing it in 1 day. But that's really and it's proved really the accuracy and also the timeliness of what's going on with your closing process. So that's good stuff to remember here, how much these automated systems can help you. I'm like, there was something else I was going to mention about that, but I forgot what it was. So let's continue on here. There it is, ERP. On that prior page, ERP system talks about that in the middle. How to achieve a fast close. you know, back when I was at NFS talking about these automated systems, and we had financial systems there, it's really more batch mode. I'm not sure if you're familiar with batch versus real time. When I left NFS, we'd put in a lot of real time systems that you make a journal entry and hit enter and post in, or your boss would hit post. It would automatically update your general ledger. That's how most of these small server, small PC packages work now as well, like QuickBooks. But at NFS at the time, we had a lot of batch systems that you didn't have. It was all paper as far as your purchase order was paper. Your receiving ticket that came from your receiving area was a piece of paper. And then you received an invoice in the mail. So you had the three-way match, something I talked a lot about in 30/20 that most people probably think, what's he talking about? But that three-way match in order to pay someone, that was all paper. Now it's all automated with the receipt. The purchase orders online, and then a lot of times the invoices come through as an e-invoice that gets matched up. Now somebody has to oversee that and make sure everything looks okay before you actually generate payment. But it was a tedious process, and it took a while to go through that and to do the accrual, and that's why it took quite a bit of time. You know, I also spent 2.5 years at First Tennessee Development District here in Johnson City. And there we had a software system similar to QuickBooks. It was called Cougar Mountain, of all things. And it was a good little system and what it allowed you to do. But all the receiving and processing of matching up was like I did at NFS 30 years earlier. Nothing wrong with that. You're a small company, 50 people, $7 million a year. You need to pay hundreds of thousands of dollars for software? No. So we had a package that did a lot of the financial reporting and check printing for us, and really good little system that we paid, I think, $30,000 for. But that was all paper matching up. So companies still do that. And if you're a small company, and there's nothing wrong with that, you have internal controls for that. And Blackburn Children's the Gall would audit our books every year because we had all that government money flowing through there. Very important. But it just depends on your size of organization. We talk a lot about this stuff. So I've seen it from very small all the way up to very large corporations. And once you learn the process, automation can help a lot. But a lot of times, if you're not careful, the automation can just make things even more confusing than they need to be. So looking here, achieving a fast close, it talks about documenting the existing closing process. It's always important to document what are you doing. That's why it's so important to be a systems person and learn as much about systems as you can. That's why I always stress how important computer science is. But documenting the system that you're using. You know, we talked about forms and reports, audits, making sure that you're not generating a bunch of garbage that nobody looks at every week. Get rid of some of that stuff. How to achieve a fast close, down on page 324. They show the payables closing process, but again, this is based on really more of a non-automated process. You know, they're throwing stuff out there. I can go up just a little bit. It won't let me do that. I guess I can make this smaller. Maybe. Receiving log, I mean, accruing unbilled supplier invoices. That was the other thing about, you know, as much as I talked at Exide and Lear about these invoices or these receipts of goods and services that are done on the docks, really goods, not services. Well, if you got services going on that you don't really know how far along are they through that. I mean, you got the purchase order, but again, you don't accrue purchase order commitments, you accrue obligations. And so services, oftentimes you have to make a judgment call there to how much of that should you accrue, if any. And that's what automation will help you a lot, but there's still some things that you got to look at as far as the rendering of services by whoever's doing work for you. And same is true for on the other side, as far as accruing revenue that you've performed the obligation for somebody else, but you haven't been paid for. In the accrual base of accounting, we know revenue recognition that we have to accrue that. And that's why it's important as well, because the other thought I wanted to bring up just a second ago has to do with really the materiality of invoices. Now, if the goods and services are being accrued and you've always got something floating around, always something floating around that maybe there's not a receipt for, maybe they just, I don't know, whatever it could be, services, something like that. What's the threshold for where you want to do an accrual? Well, at Exide, our threshold was $500. So if I had anything less than $500, like a $450 work somebody was doing on, I don't know, the plumber had to come in, you know, the work's done, you don't have the invoice, right? Maybe it's in the office area, they came in and worked on something. You know, the work's already been done, you just don't have the invoice yet. So do you accrue that? Well, if you've got a policy that says $500 is the threshold, then we're not going to accrue that. And same is true for something $50, $100. You're not going to worry about stuff like that. You don't have time. You can't cross all the T's and dot the I's. You have to make sure you get the big stuff done, the big accruals. Something manual, or, you know, the vacation accrual. If you had me in 30/20, remember the vacation accrual Excel assignment that I had for you that you put together, and it was really to show how to use Excel and nested if statements and so forth to do something that's a download from your mainframe to do this accrual. With the vacation accrual, something I looked at every month. I just didn't do it at the end of the fiscal year when they had earned a vacation for the following year. And at Exide is over $1 million. Every month I would compare actual payouts, right, from the accrual, and then what's remaining for the rest of the year that HR is keeping up with when people take vacation. If they're being paid different rates of pay based on an incentive, then your accrual is going to be off. Is it under accrued? Is it over accrued? So vacation accrual, you got things like your electric bill. If the meter's being read at the end of the month and you don't get the bill to the 5th, well, if you got to close the books by the 2nd, you got to make some kind of an estimation, whether you're reading electric meters or whatever, but some process. And your auditors aren't that tough that they're going to say, well, you missed it by a couple $1,000 or even $10,000 if you got a $400,000 bill. But you've got to get things done in a short amount of time. And like I said, it gets shorter all the time, and you've got to use automation to help you do stuff like that. And if you didn't have automation, you didn't have Excel to do like a vacation accrual, you'd never get it done. You'd spend 2 days doing nothing but vacation accrual. So you've got to learn how to use these software packages that are available to you. All right, the next page. They've got several things out there. Count and value inventory. Halfway down the page there, it's got payable, invoicing, pay. See, that's most of what you're doing. Payroll activities, invoicing, payables, inventory. Payroll, invoicing, payable, inventory, cash, final closing. And you can see from left to right there what you got to do in each of those days. Look, they would go all the way out there to day 6, 7, 8, 9, 10, day 11. Some companies, and of course, this is including both your corporate office and your plant locations. But again, looking at this payroll, you know, when I first started at, of course, nuclear fuel, we closed the last day of the month. Interesting, when I was at Exide, this was in 1994, 95, Exide chose to say the month ends on the last Friday of the month, whenever that is, the last Friday of a month. And they didn't do any accruals for the hourly workforce. Now, salaried people were paid once a month. So obviously there was no accruals for salaries. You get paid there at the end of the month, and they made sure that the checks and all the processing through the general ledger was complete by the last day of the month and posted. But for hourly people who were paid weekly, you can see that there would be most times days at the end of the month that they fell into the next month. Well, apparently the auditors didn't care. It was Arthur Andersen at the time, which was really the big 8 accounting firms, which is now consolidated down to 4, the big 8 accounting firms. Arthur Andersen, they didn't have an issue with that. I guess they felt like it didn't make that much difference. Of course, later after Exide merged with GMB in and PwC were the auditors. Of course, Enron went away in 2001 or 2002. I don't remember when we merged with GMB out of Atlanta, but then we changed to where we had to do accruals, much like you would think. And we kept paying people the same salary. You pay once a month, no big deal. But the hourly folks were paid every Friday based on work through the prior Sunday. So you can see there, you would always have a certain amount of days at the end of the month that you would need to accrue. And of course, those days within the accrual would reverse out in the next month once you made the payment the first Friday of the new month, right? So in the grand scheme of things, you see what we did back in the 90s, it wasn't that big a deal. It's generally just a one-time thing that if you decide to accrue through the end of the month, it's just a one-time thing, because over time it's the same, except for that 1 month that you're doing the accrual at month end. But I guess that's why ECCT probably looked at it, was just to improve the accrual process and the whole closing, not improving the accrual process, but improving the whole closing process at the plant locations. The payroll, accounts payable, that's such a key, and then inventory. I mean, those are the big three in any company. Your fixed assets, once your projects are closed, they're being depreciated. You really don't pay that much attention on a monthly close, what's going on with depreciation. You really don't. It's all automated. You got your fixed assets as subsidiary modules. If you looked at those sheets that I put out last week or 2 weeks ago for how we closed that nearly $30 million project, and the account codes it goes to, once you set that up, it just goes every month until the individual assets are depreciated down to zero. And then of course it sits there on your books at zero value, but you really don't do much with depreciation on a monthly basis. It's just there. Corporate people that do nothing but work in fixed assets would beg to differ, but in reality, there's really nothing goes on there. They're always wanting to know how much is in CIP, construction in progress, that needs to be closed and taken out of that asset, CIP, and put into what? Put into an actual depreciable asset. They don't like a lot of stuff sitting there, and auditors don't either. They're always wanting to know, is this capital project, are your assets producing revenue? So you need to tag it, fill out a close form like you saw in that Excel sheet last time or 2 weeks ago, and get that thing to where it's off CIP and into an asset, a specifically identifiable asset that's generating revenue. All right, and so then inventory is a big one. How much have I talked about inventory this semester? Count and value inventory. Well, if you've got cycle counters, you've got 4 of those in your plant and 4 of those in your distribution center, then you're doing physical inventories every day. You're doing a physical inventory on your perpetual system to make sure all the barcoding and all the reporting on the shop floor, all the receipts, all the shipping, all the scrap reporting, all that is being performed. So count and value inventory. In the early days of ECCT, we would actually do a physical count once a month before we had a system of cycle counters, just to make sure our perpetual was right. And it wasn't a big deal like the 3-day shutdown once a year where you did a really thorough physical inventory. We actually did a physical count every month, and smaller companies do that. And we were small at that time. That's why we would do a physical count once a month. And usually it's just the materials manager and his folks would actually go out and do that. Of course, when you turn something like that over to someone who's doing the buying and using a material, as you start to wonder if his counts are accurate. I can't tell you how many times that he would actually want to book an inventory loss. And I think a lot of times he would deny. I think a lot of times it's he was trying to get stuff off the books because it made his balances of inventory look better. Well, what he doesn't realize is if it's not in his inventory, it goes to the bottom line as cost of goods sold. And of course, materials managers, supply chain logistics, they oftentimes don't understand how important your net income, net loss is. If it's not in the inventory, where is it? You know that from basic 2020 accounting. If it's not in your inventory, it's in cost of goods sold. It's got to be in one of the two. It's in between. And I still remember he used to make comments to me because we'd have this conversation every month. Boy, I don't miss that. The more I think about it, the more I'm glad I don't have to deal with that anymore. We'd have a conversation every month, and I still remember him saying, he said, Joel, all you care about are the dollars. I just care about the quantity. Well, it's the same thing. If you're going to take 1,000 pounds of lead off your books, that's $300. It's not, they're the same. But you get the gist of it. All right, let's continue on. I'll start rambling again. Altering the timing of closing activities. I talk about bank reconciliation. Then you're talking about at an Exide or Lear, you didn't have to worry about that. That was a corporate function. When you're in a very large company, all this stuff is separate. Those of you who have interned at Eastman, other companies that are large, there's so many different departments that they're just focused on their one thing. But bank reconciliation, I will point out, when I was at First Tennessee Development, the process of purchasing, accounts payable, receiving, writing the checks, signing the checks, all that was by several people. Even a company of only 47, 48 people, several people were involved in that. And the only part really, I had oversight of all of it, but didn't have authority to do any of it, except what I had authority to do was the bank reconciliation, because that's the end game. That's when you get your bank statements and you compare your bank balance, right? Your bank balance with your book balance, your general ledger. Is your general ledger balanced with your bank? And if it doesn't, why? What's outstanding? I know nobody does that anymore with their checkbooks, except me. But that's what we should do, because that's what you're going to do in business. And what's the difference? And of course, all those checks that are coming through that have been signed, you can look at those checks have been signed, who they went to. I mean, that's the acid proof of what's going on in your company as far as disbursements. Now, if you have thousands and thousands of checks, that's hard to do. But for a small company like First Tennessee Development, I don't know, we probably had a couple hundred checks a month. But you could go through those checks, just accounts payable, and tell if, is there a vendor there that looks kind of funny, like ABC Incorporated or something like that. And then you start to look and say, well, I don't know where that company is. And you should do stuff like that. You need to be that's sort of a hawkeye about stuff like that. But bank reconciliations, that's not really, it's part of the closing process, but it's not part of the deadline. That's just something you need to get done as soon as possible. Overhead allocations, if you're using a standard cost system, overhead allocations is something that rolls once a year. Once your budget is set up, then the budget drives your whole cost roll of updating all your cost standards based on your labor routings and based on what you have projected for your variable and fixed cost for the coming year. So the overhead allocations is really a one-year thing in large companies. I'm not sure about a smaller company with overhead allocations. By recurring invoices, I always knew I had to do, if nothing else, make sure you do your electric power bill and your natural gas. Those are two that big dollar items. You had to make sure that those were put in every time at a plant location. Very simple. Bad debt reserve there. You need to change your allowance for doubtful accounts. You know, you remember from 30/20, what did you do there? Your allowance for doubtful accounts, because you're required to do an allowance or an estimate based on GAAP. You can't do the direct write-off method, can you? When somebody doesn't pay their bills and you write it off, no, you have to do an allowance in the period in which you made the sale. Same thing you do with warranties. You don't just write warranties off on a cash basis. You have to make a warranty accrual, right? A warranty accrual when that good is sold to relate to that. And then as things change, maybe your warranties are running higher. You need to increase that percentage. What do you do when you have a change in estimate? Remember, you don't make it retroactive or retrospective. You do it in the current period that the books are open and future periods. All of these change in estimates for loan losses, like we had First Tennessee Development, or bad debt expense, allowance for doubtful accounts, warranty accruals, your inventory, if you've got inventory losses, making an accrual there for that based on new information. Interest expense, unpaid wages. Again, the accrual at the end of the month for that, it's very important. Even though we didn't do it at Exide earlier. There it is, vacation time. That's a big one. If you got $1 million in accrual being paid out over a year, says they don't update frequently. I looked at it every month. It's simple. Once you have it set up in something like Excel, it's simple to do. Account reconciliations. It's what your auditor's going to be looking at, especially your assets. They're going to look at your assets and see if they're overstated, because if they're overstated, where should it be? It should be an expense. You know, they didn't look at the liabilities near as much. I mean, they do, but not near as much, because how does the liability show up there? Shows up there through expense, right? I mean, they would want to know, they would want to make sure that you had all your liabilities recorded for things that are, remember the terms, probable and reasonably estimable. That's what is required. If it was likely, you would just disclose it. Or reasonably possible, is that the terminology? About forgot from 30/20. You would just disclose that and not make a journal entry. So that's important. But looking at assets, they looked at assets because if the assets were overvalued, they knew it had to go to where? It had to go to expense. And so these account reconciliations here says it is absolutely necessary to keep track of the contents of the larger asset and liability accounts to ensure that costs are not inadvertently parked on the balance sheet instead of being charged to expense in the correct period. That's a great 4 lines. Great 4 lines. Depreciation, not quite as big a deal. Commissions, if you're calculating commissions for your sales folks. Financial statement error review. Rebillable expenses. Let's jump down to page 331. I've been talking about 30 minutes already. Boy, doesn't time fly when you're having fun doing stuff like this? 331, optimizing the use of journal entries. I think I've talked about this already. Centralizing accounting activities. Next page, page 332. A lot of that goes on. Don't think if you're at a plant location, a lot of this stuff your corporate office is going to take care of. And when they're taking care of it, it's like each area doing their thing. Only when you get really high up, like as a corporate controller, are you looking at everything. Sort of a jack of all trades, and what's that old saying? Jack of all trades and master of none. That's actually a misquote. It's jack of all trades, master of one is what we're supposed to do, right? Remember that. I can't remember who said that. I think maybe Ben Franklin. That's a good quote. You should be an expert at something. And you will be when you get into accounting, like you're going to be a cost expert or a tax expert. I don't know how much y'all love tax. Page 333. Look at the bottom of the page there. Specific improvements to functional areas. Number of best practices impacting specific functional area. Inventory, without a doubt. The finest closing related inventory. Best practice is to create an extremely accurate inventory tracking system. Inventory accounting, John Wiley and Sons. I think some of y'all may have that book because I see you quote that sometimes on your papers. That's good. The more you learn about inventory, the more, that's when you're really getting out of, it's where you're really getting out from just being a controller and being like an office person, a pencil pusher, to someone who knows what's going on with your business, because your inventory tells you what's going on in your business. It really does. I think sometimes we ought to have a class on nothing but inventory. Billing, revenue recognition. Well, that's a real challenge. Now, as much as we talk about automated, I was talking about the 3-way match on the expense side or inventory side. What about or CapEx side? What about the revenue recognition side? And if you had me in 30/20, you probably remember me talking about revenue recognition and what we did at Exide. Well, our customers, probably a third, maybe a half of our customers were Toyota or Nissan. And in the case of Toyota would actually come and pick up the batteries with their trucks. All right, that's pretty clear. When a battery went through the dock doors, through the threshold of that trailer, and they took possession at that point. we would do what's called a ship confirm in our financial system, our ledger system, which is our material handling system. That ship confirm automatically created 4 transactions, right? Debit accounts receivable for whoever the vendor is, Toyota, credit to inventory. I get that right? No, sales. Debit to accounts receivable for Toyota, credit to sales revenue, debit to cost of goods sold, credit to inventory. Now it's a little more involved than just those 4 lines as far as the account titles, but that's really what you're doing. And that was simple. And whatever happened up to 12 o'clock, midnight, the last day of the month, that was revenue. But the other part of that, that's half of your business. If you're assuming that's what happened with Toyota, I don't remember Nissan, but let's just assume that's all these to control the just-in-time inventory systems that they had in their automotive plants. They told you when they were going to come and get their products, so they sent their trucks. Exide doesn't have any trucks. We're not a logistics company. Then we would use Covenant, Swift, MSDS, all the SAI, all these different trucking companies to ship our batteries to Walmart, to Sam's Club, to O'Reilly's, AutoZone, yada, yada, all those different companies that were buying our batteries. Well, this was on carriers that we used through our freight budget out of our corporate office. We didn't have to worry about that. Corporate did that for us. These trucks would pick up our batteries. Same thing happened. As soon as it went through the threshold, it came off our books as again, debit to accounts receivable, credit to sales, debit to cost of goods sold, credit to inventory, off our books onto their trailer, and then it would leave, and who knows when it actually got to the destination. Now, if it's going to Sam's Club or Sam's Warehouse down here, I think in Greenville, that was the same day, no big deal. But the entire route from the time that it leaves our plant till it gets to those docks at Sam's, it's still Exide batteries. We had a trailer that turned over a mile from the plant one day. All those batteries were still ours. They weren't Sam's or whoever. I don't know if it was Sam's Club that it's going to. Whoever it's going to, it wasn't theirs. Ownership hadn't passed. That whole performance obligation, all that stuff that's thrown out there now, ownership had not passed. Title had not passed. As you say, it's FOB destination, right? So it was still ours. Well, if it came off our books, I just told you what those 4 transactions are. That's revenue that's recognized. Well, you can see the issue there. And that went on for years till, and even during the time of Arthur Anderson, PwC, the one that said that, well, you need to do some kind of an adjustment at month end. And you didn't have time to wait to see when these trailers got there. They were en route. They may be sitting on the lot there waiting to be unloaded, right? Sam's. But what if these batteries were going to Maine? What if they were going to Detroit or somewhere down in Mississippi? Because Exide was the only plant east of the Mississippi. So we did all the shipping all over the eastern US. What if it's going to Miami, Florida? A couple of days, more than likely, right? You only drive, 10 hours a day? Is that what the truckers can do? You can only have 42,000 pounds on your trailer, or else you're going to violate. So those 1,000 batteries or so, they're all over the place. And this is what Exide still has ownership in those batteries. Well, you can't book revenue. Well, the revenue's been booked. So guess what I had to do? It wasn't just me. They had to do the same thing out in Kansas because they shipped to the West Coast, which is probably even longer to get there. PwC said, well, we understand you got to get the books closed. So what we're going to allow you to do is any shipments you have in the last 3 days of the month, last 3 days, and we work 24/7 in shipping and distribution. Whatever you ship the last 3 days, 50% of that will allow you to take credit as actual revenue. That sounds reasonable. You think 3 days, probably what's shipped 3 days before month end. If the month has 30 days in it, what is that, the 28th, 29th, and 30th? Those that shipped on the 28th, probably 90% of those have been delivered, but not all. Probably 50% of those 2 days before have been delivered, and probably 1 day before, or the last day of the month, maybe 10%. And so they, whatever those percentages are, I don't remember, average together, they feel like 50% was a good number for the last 3 days. But that doesn't mean you don't ever get credit for it. So here I was making a reversing accrual. I was reversing revenue that was recognized, right? The opposite of what, and this was all done through the ledger. We didn't change the inventory on our books. Excuse me, we didn't change the inventory on our racks by flushing stuff back onto the racks. You don't want to do that. Once it leaves your facility, you want your inventory to be accurate, especially when you're doing a physical inventory that one time a year. So what we would do just from a high level is make a journal entry to take it out of cost of goods sold, put it back in the inventory, not identifiable inventory, but just inventory as an asset on your financial statements that nobody knows what you're doing except for the accountants. And also take it out of accounts receivable, and you also want to take it out of sales revenue, more importantly. So you were debiting sales revenue, crediting accounts receivable, debiting inventory, and crediting cost of goods sold for 50% of the revenue from the last 3 days of the month. And that entry would be put in on the 30th or the 31st or the 29th, whatever it happens to be. And when that entry was put in the very first day of the next month, like if you did that on March 31st, on April 1, you would completely reverse that entry again to make it the same as it would have been had you not made that other entry to begin with, right? So it's not like you're not getting that 50% of your revenue for those last 3 days. You're just going to get it on April 1 instead of March 31, right? All right, so that's important to talk about as far as billing and revenue recognition. Payroll, big deal. Payables, we've already talked about that. Cash processing, you know, that's a big part of reconciling your general ledger cash accounts. And we had a bunch of them at First Tennessee Development. We had, I think, 12 bank accounts, I believe. A lot of them were because we had different loans to different localities. You had to keep all that separate. So I spent a lot of time doing bank reconciliations and getting confirmations once a year for your auditors to look at. Workflow management, consolidation software, data warehouse. I'm not sure I want to have anything to say about any of that. Sounds like Forrest Gump. That's all I have to say about that. All right, summary. They're on page 339. Closing the books can be a fascinating study in improving departmental efficiency. What it really is. When you have to get something done, you find ways to get it done. That at Lear, though, I was only there 3 months, but you talk about a challenge. And they had so many separate systems that they were wanting. That's probably one of the reasons they hired me. They were wanting to go to an SAP system with what they had. And that was something I had tribal knowledge about. Ever heard that term, tribal knowledge? All right. SEC filings. Let me go over here and look at this. Closing the books PDF. Hopefully this is going to open. You can still see it. I think I've gotten better about this. I think you can't share something unless you're in that Zoom menu. There it is. This is a short one, 5 pages. Yeah, it's old, winter 1995. But relevant. I think it's interesting to see where companies have come from. If you look at this particular example, if I can make it a little larger. Best in class, best practices. You know, that's a great thing. Learn from other people, learn from other facilities. Your corporate office should be helping you there, but sometimes you just got to communicate with your other counterparts at other locations. I mean, plant controllers like myself, when I was at Exide, talking to plant controller at Salina, Kansas, Manchester, Iowa, various places, a lot of other plants that have since shut down. You can learn a lot from people who are just like you that have the same challenges. So when you see best in class, very important. I like all this stuff going on right now with this COVID-19. You see some states seem to be doing a lot better than others. If you just look at the numbers, and without getting into the detail of what's what, but there should be a lot of best practices come out of this, like which states seem to have done a better job than other states. And these states should not just ignore it and say, throw rocks at them, learn from it. We should learn from other countries like South Korea. I don't know what South Korea is doing that's better than what we're doing, but they had infections there a lot sooner than we did. And they were able to really, and I guess they're a democracy or republic like us. And then you see places like Italy and Spain and United Kingdom. Those are probably the big three that they're all about 60 million people. And we were the same trajectory as they are, and their number of deaths is, of course, they've got 60 million people. If you multiply theirs by 5, I mean, that's equivalent of 4,000 people a day dying here. So we're doing better than they are with what we've done. But do we know why? And see, that's why, I talked last time about the 5 whys works on anything, whether it's accounting, increasing your process here, your efficiency, or how to drive better healthcare. I mean, all of this is same concepts that should be used. And healthcare is probably one of the areas that has the least amount of, next to higher education, for process improvements, although they are coming along. Some people say, well, that's why there's issues with the hospitals. They do have process improvements and have cut back too far, but I don't know about that. But that's something we should do as accountants here. Closings of only 4 days or less. Again, this is in 95. They're probably talking about the entire process in the corporation more than likely. And I believe excise at that time was probably 5 days, maybe 6. But they allowed us 3 days, but they ultimately cut that down to 2 days later on, even though we were about the same size. I don't know if I've got any comments. You can just read this for yourself. Counting benchmarks. You need to benchmark yourself, and you need to have a policy. The policy is you got to close the books in 2 days. What's the procedure to do that? And just list. And I know I train other controllers at other locations. That's what I would go through every month, or I would go through with them what I did every month at month end. And once you look at that, what you have to do at the end of the month for your corporate office, then that sort of drives what you're doing day to day to get to that point. But have everything, a checklist, really a checklist of all that stuff. After Sarbanes-Oxley, SOX, back in 2002, 2003, all that came about after Enron. I had a long questionnaire. It must have been 100 questions or more. I wish I'd kept one of those. I asked the controller up at Lampeter to send me his, and it was only like 10 questions. Of course, it's really a injection molding plant. It's not like what we had here in Bristol. But all that stuff on their checklist, you need checklists for stuff like this, that you're doing all the stuff that you need to do. And don't just say, well, I remember we have to do this or I have to do that. You need to document that. So important. And make sure people who work for you document what they're doing. And again, we were doing soft closes, or going back to the beginning, we were doing soft closes on I was doing a soft close on a weekly basis to do the forecast. And of course, then a hard close every month. And then every 3 months, because you're a publicly traded company, you need to make sure your quarterlies were really tight. And the annual close was critical, because that's what was going to get stamped in stone for the auditors to look at. All right, well, I won't bore you by reading through that. It's really short. Looks like it's only about 3 pages. So please read that and tie that in with what we just talked about in the fast close. We'll go ahead and go back and look at the SEC chapter, and I'm going to go through that pretty fast because it may be a while before you have to deal much in SEC. SEC stuff. And again, you may be in it right off the bat. I didn't deal with SEC filings. I never worked at the corporate level in a company that was publicly traded. I did at Nuclear Fuel where we were looking at issuing stock, but it never got to that point. But what are some of the key things in this chapter? Well, SEC is for a publicly traded company. Your stock is being traded. You've got what's called an 8K, which tells you there is for a material undisclosed event that might occur, and they give you several examples there. Probably the ones most common are 1.02, material definitive agreement, maybe a plan of a merger, termination of a planned merger, which is M&A activity, is pretty common, although not right now. Bankruptcy, receivership. I mean, I was a part of Exile when they went Chapter 11 back in 2002, but the corporate office pretty much had to, they're the ones that took care of notifications on things like that. But all of these are 8K, Form 8Ks. If you go over to, I guess 2.06 is a part of that. Material impairments, page 344. Impairments is a big part. If you ever, we had impairments at Exile when the plant shut down in 2013, when you stop depreciating and then you make the determination, am I going to sell this equipment, these assets, or am I going to stop and then move it somewhere else? And of course, there's rules, regulations for how you handle that as far as your write-downs. Write-downs to fair value because the future cash flows from that equipment, future cash flows are less than the book value of the asset. Remember that on impairments? Now you do. All right. And then section 4, changing the company certifying accountant. I'm sure they did that in Reading, Pennsylvania, Exide's headquarters, when they went from Arthur Anderson to PwC. And I think that was before, I think that was before the Enron collapse. I think they just, even though Exide bought GMB Technologies out of Atlanta, they chose to let GMB kind of run things. Very interesting. Skipping on over to the 10K, those are the ones you hear most often on page 348. Annual 10K and quarterly 10Qs. That's why quarterly closings are so important. Annual closing, because you're going to report that to the SEC, Securities Exchange Commission, because you're selling stock and people have a right to know as owners. All right, that's probably about all I want to talk about in this chapter. And they go into some really specifics over there on page 354 and 355 about Fed wire payments. Interesting. All right, so the last thing we're going to look at here is theory of constraints, wherever that is. Herbie is alive. And I hope you can see that. Herbie is alive and well. Who is Herbie? You ever heard of the theory of constraints? Yeah, a short article. What is it, 2 pages? Don't you love that? So please read this. Interesting article here about the theory of constraints. A great example of how important real process management is. That's process management in your accounting department and also in your manufacturing facility or your warehouse, wherever that might be. What about bottlenecks? Where's the bottlenecks? If you walk through a plant, if you walk through a warehouse, you can pretty much see that if you know what you're looking for. But read this, very interesting article. And feel free to write about that in your weekly paper as well. Well, I'll just stop there. I think that's less than 1 hour for a change, right? All right. Next week, this is April 9th. Next week is the 16th. There's a Excel sheet in there I'm going to go over next week as well. It's kind of late in the semester to look at that. It's fairly short that I want you to work on. But I'm going to go through it next week and show you what I'm looking for, because I just want you to have some sort of practice with doing a flex budget before you get out of this class, because it's something you're going to encounter no matter where you work. So it's important. And when we look at next week, the 16th, it's going to be chapters 20, 21, I don't remember if 22's in there or not. Probably look at that as well. And then they'll just leave either 2 or 3 chapters for the end. But that final week on the 23rd, I believe, I probably will have you turn that Excel sheet in as part of that weekly paper. But the weekly paper will only be, we'll just limit that to like two pages and then turn in that spreadsheet, which probably wouldn't take you 15 minutes tops. So that'll be the last week. And I'll talk more about it next week, but that'll be the last week. And then you'll have the next week off to work on your final paper. If you need any guidance on that, feel free to ask. I think 1 or 2 of you have asked about that. Feel free to ask me. If there's something you're thinking about, if you need some direction, I'll be glad to try to help you there. But otherwise, I hope you're doing well. Looks like things are improving a little bit in general, right? So study hard, get this done. The SAIs will be out there soon. I know it's be interesting how students will react to that with going to online, but those SAIs are for our accreditation, which we are going through this year. It's every 5 years, so they look at that. So obviously, be honest with your appraisals of this class and any class that you have, but keep in mind as well that this obviously has an impact bearing on our reaccreditation. So hope you have a good week. If you have any questions, feel free to email me. I'll get back with you as soon as possible.